Okay, let's unpack this. We're diving deep into the engine room of management finance. Cost volume profit, or CVP, analysis. This deep dive is really designed to give you the ultimate shortcut, a genuine managerial crystal ball, if you will, by showing how systematically separating costs can transform, raw financial data into this powerful predictive tool.
It's the absolute foundation of business confidence. You see, a traditional income statement, the kind you give to shareholders, is essentially useless when a manager asks a what-if question.
What if we raise the price? Or what if our
Yes.
rent goes up?
Exactly. It just doesn't give you an algebraic way to forecast because it doesn't separate fixed and variable costs. So our mission today is to master CVP, to move past just knowing what happened last quarter to being able to predict with real confidence exactly what will happen.
And that systematic approach, it has to start at the very beginning with the foundational building block,
Like what?
understanding cost behavior. Before you can trust your profit calculations, you have to trust the numbers you're plugging in.
Right. We're talking fixed costs, variable costs, and of course those famously difficult mixed costs.
Let's define those.
Sure. Defining them correctly is step one, but I think it helps to visualize them too. A variable cost is any cost that increases directly and proportionally with activity volume. If you were to plot this on a graph, it just creates a clear upward sloping line.
And that slope is the variable cost per unit.
That slope is the variable cost rate, yes.
Mm.
The change in cost divided by the change in activity. So if you're building a car, the, say, $150 cost of the steering wheel is a perfect example.
And then on the flip side, we have the fixed costs.
Those are the reliable ones, the constant costs that stay exactly the same no matter what you produce, at least within a certain range. Your monthly factory rent, maybe $2,300. That's the classic example. You plot that. It's a perfectly horizontal line. The landlord gets that same check whether you make one steering wheel or 10,000.
Okay, that part is pretty straightforward. But the complexity, and this is where I think the analysis can really stall out, is dealing with mixed costs. Those expenses that have a fixed part, like a base fee, and then a variable part, like a usage charge. If you can't break those two apart accurately, your whole CVP analysis is just built on a shaky foundation.
It is. You need tools to do that separation. The two main methods we focus on are the scattergraph and the high-low method. And the scattergraph is critical and often overlooked because it lets you see the integrity of your data. You plot all your historical data points and you can visually spot the outliers.
The outliers being what? Like a month where a massive random maintenance expense just skewed the whole picture.
Precisely. So the graph isn't just about finding a line. It's about cleaning your data first. Once we've done that and we're confident in our high and low points, then we can use the high-low method. Let's use that example from the source material. We have a high point of $90,000 in cost at 18,000 hours.
And a low point of $48,000 at 4,000 hours.
Okay, so the difference in cost is $42,000. And the difference in activity is 14,000 hours.
So you just divide one by the other.
You take the change in cost, the 42 grand, and divide it by the change in activity, 14,000 hours. And that immediately gives you the variable cost rate, $3 per direct labor hour. And once you have that, you can plug it back in to isolate the fixed cost component.
Fantastic. So we've separated our costs, we trust our numbers, and that unlocks the next stage, which is, it's arguably the most powerful concept in management accounting, the contribution margin.
It really is. I call it the moneymaker. It's what you get to keep from every single sale after you cover the direct variable costs of making that thing.
And the mental model for you listening should be very, very clear here. That margin, it has two jobs and only two.
That's right. And they happen in a specific order. Job number one is paying off all your fixed costs. Job number two, and only after job one is done, is generating profit.
It's like a funnel, right? Every sale pours a little bit in. First, you have to fill up the fixed cost bucket, and then, only then, does it spill over into the profit bucket.
That's a great way to think about it.
Yeah.
And the simple fruit analogies make it really tangible. Take a hamburger. You sell it for $2. The variable costs, the meat, the bun, the labor to flip it, that's say $1.40, that leaves a contribution margin of 60 cents per hamburger.
Or that restaurant meal example, a $15 price. You have $9 in variable costs, $5 for the food, $4 for the server's time. So that $6 CM per meal is what's paying the rent.
And the kitchen manager's salary. Without that number, you're flying blind.
Which brings us to the reporting difference. Why do we need a whole separate contribution margin income statement?
That's a really important distinction. The traditional statement is for external reporting. It follows accounting rules and groups costs by function, like cost of goods sold. The contribution margin statement is an internal tool for managers. It groups cost by behavior fixed versus variable. It's useless for a banker, but it's essential for a manager.
Okay, let's see that in action with the Jules Core baseball glove example. They sell 1,000 gloves, which brings in $200,000 in revenue. First, we subtract the variable costs of $110,000. That gives us our key line, the contribution margin of $90,000.
And then you subtract the fixed costs of $63,000 to get your profit of $27,000.
It's so clean when you lay it out like that.
Right. That $90,000 CM line is the pivot point. Everything above it is tied to volume. Everything below it is fixed. And that unlocks this fascinating concept called operating leverage.
And this is where we move from just accounting to actually predicting the future. We know the profit is $27,000 right now, but what happens if sales increase by just 20%, from 1,000 to 1,200 gloves?
Okay, let's run the new scenario. Total sales are now $240,000. Variable costs go up proportionally to $132,000. The new contribution margin is $108,000. Now here's the secret sauce. The fixed costs, that $63,000 for rent and salaries, they do not change.
So we subtract $63,000 from $108,000, and the new profit is, wow, $45,000.
Exactly. Sales volume went up 20%, but profit jumped by 67%. That massive acceleration, that is operating leverage in action.
That's incredible. Why does that happen? Why does profit grow so much faster than sales?
It's because once you sell that very first unit past your break-even point, in this case the 701st glove, the entire $90 contribution margin from that unit and every single one after it drops straight to profit. You've already paid the rent. Fixed costs are your biggest risk when volume is low, but they become your biggest asset when volume is high. They magnify your profitability.
Which makes the case for maximizing volume so incredibly strong once those costs are covered. So let's talk shortcuts. The ratios are what let managers do this math in their heads, right?
They're essential. So sticking with the glove example, the variable cost ratio is $110,000 divided by $200,000 in sales. That's 55%.
Meaning 55 cents of every dollar that comes in the door is immediately gone.
Gone. To cover the variable costs, what's left is the contribution margin ratio, or CM ratio. That's 90,000 divided by 200,000, which is 45%. 45 cents of every sales dollar is available to cover overhead and then finally generate profit.
And the relationship is simple. Variable cost ratio plus contribution margin ratio always equals 100%.
Always. If you know one, you know the other. It's your fundamental quick check tool.
So if sales go up by $10,000, you don't need a calculator. You know that 4,500 of that is dropping straight to the bottom line, assuming you're past break even.
That's the real-time power of the ratio approach.
Which brings us to the ultimate tool, the CVP equation itself. The core formula is profit equals sales revenue variable costs fixed costs. But the real power is rearranging it to solve for whatever you don't know.
Exactly. Let's run through the 3 key scenarios managers use this for, starting with survival mode, break-even analysis. Break-even is when profit equals 0. What that really means is you have to sell just enough so that your total contribution margin exactly equals your total fixed costs.
Okay, using the Jules Core data, 63,000 fixed costs and a $90 contribution margin per unit. We can solve for the break-even in units.
Well, we just take the fixed cost, 63,000, and divide by the CM per unit, which is 90. That gives us 700 units. That's the floor.
But units aren't always useful. What if you sell 20 different products? That's where the dollar approach is better, right?
It is. It's often more powerful.
Yeah.
You just take the fixed costs, 63,000, and this time you divide by the CM ratio, 45%.
Which gives us $140,000 in required sales.
Right. So the manager doesn't need to worry about which 700 units to sell. They just need to hit that revenue target of 140,000. It's a much more actionable goal.
Absolutely. Okay, scenario 2, the growth plan. Target profit analysis. We're not aiming for 0. We want a specific goal, let's say $36,000 in profit.
The formula adjusts so beautifully for this. You just treat that target profit as another fixed cost that your contribution margin has to cover.
So the formula becomes units equals fixed costs plus target profit, all divided by the CM per unit.
Exactly. So we combine the 63,000 in fixed costs with the 36,000 target profit. That's 99,000 that needs to be covered. Divide that by the $90 per unit.
And you get 1,100 units.
And you can always use the trust but verify method. Plug 1,100 units back into the income statement, and you'll see it gives you exactly 36,000 in profit. Simple, clear, verifiable.
Now for the advanced test. Scenario 3. What if the target isn't a fixed dollar amount, but a corporate goal, like a 20% return on sales? This is what investors often demand.
This changes the game a little bit because
Yeah.
now your profit goal is moving with sales. Algebraically, it starts to behave like a variable cost. You have to set up the full CVP equation.
So that would look like $200 times X units minus $110 times X units minus 63,000. All of that has to equal 20% of $200 times X units.
Right. And when you solve that full equation for X, the required volume jumps up to 1,260 units.
Whoa, that's 160 units more than we needed for the fixed $36,000 goal. Why the increase? That is the essential insight here.
It's because when profit is a percentage of sales, every single unit you sell has to contribute to two things simultaneously. Part of its contribution margin has to go to covering the fixed costs, and another part has to immediately satisfy that 20% profit requirement for that specific unit's sale price. You need to sell more to keep the ratio right.
That just shows how powerful this is. It handles incredible complexity but stays grounded in that basic relationship.
And if you look at the CVP graph, it ties it all together visually. You have your total cost line starting up high at the $63,000 fixed cost level. Then your revenue line starts at 0 and goes up.
And the break-even point is just where those two lines cross.
Precisely. At 700 units, or 140,000 in sales. And everything to the right of that intersection on the graph, that's your profit area.
So after all this math, why does this matter so much to you, the manager, or the entrepreneur? It's more than a model. It's the framework for making decisions.
It informs every strategic choice. You need to set sales targets. CVP gives you verifiable goals. You need to make a pricing decision. CVP can tell you that if you have to drop your price from 200 to 180, your break-even point will shoot up from 700 units to over 1,000. It quantifies your risk instantly.
It also informs cost control, right? Should we outsource maintenance, which lowers our fixed costs but might raise our variable costs? Or should we invest in automation, which does the opposite?
CVP immediately shows you the trade-off and the new break-even point for both options. But we do need to add a few caveats here. CVP is powerful, but it relies on some big assumptions.
Right.
It assumes costs and revenues are linear, that your selling price doesn't change with volume, and that your efficiency stays the same. And crucially, in a multi-product company, it assumes your sales mix remains constant.
That's a key insight. You can't just blindly run the numbers. You have to understand the boundaries of the model.
Exactly. CVP analysis is the intellectual toolkit that lets you move from being reactive, saying, oh, I made 27,000 last quarter, to being proactive. I need to hit 1,260 units to satisfy my investors. It gives you control.
So we started this deep dive by understanding the absolute need to separate costs into fixed and variable. We established the contribution margin as the core insight, and then we used the CVP equation to solve for survival, for growth, and for those advanced investor goals.
And that leads to a final, provocative thought you can take with you. CVP lets you quantify the impact of a catastrophe. We saw that the glove company's break-even price had to jump to $215 if sales were constrained to only 600 units. Now, think about a local business you rely on, a coffee shop maybe, with high fixed rent. If that company could suddenly only sell half its usual daily volume, what immediate non-negotiable price change would they have to make just to keep from losing money? They might not have time to renegotiate rent. CVP is the tool they'd use to figure out that desperate price hike in real time.
That is the power of CVP in action. Keep that knowledge sharp, and we'll see you on the next deep dive.